Hi there, Vince Moore, your mortgage professional on the Central Coast, Central Valley, and beyond. And today in this video, I'll be sharing the 4 reasons why we are not heading towards another housing bubble. And if you find these videos informative, please consider subscribing to my YouTube channel, as I provide lots of good information on home loans, real estate, and the market in general. With home prices continuing to appreciate above historic levels, some are concerned that we may be heading for another housing boom and bust. But it's important to remember, however, that today's market is quite different than the bubble market of 12 years ago. Here are the 4 key metrics that will help explain why. 1, home prices. 2, mortgage standards. 3, the foreclosure rate. And 4, housing affordability. Home prices. There's no doubt that home prices have reached 2006 levels in many markets across the country. However, after more than a decade, home prices should be much higher based on inflation alone. Included an excerpt from CoreLogic from a few months ago in the body of this email explaining more on this. Mortgage standards. Many are concerned that lending institutions are now easing standards to the level that helped create the last housing bubble. However, there's proof that today's standards are nowhere near as lenient as they were leading up to the crash. And if you've tried to get a home loan recently, you would know that that's to be true. The Urban Institute Housing Finance Policy Center issues a monthly index, which I've also included in the body of this email. Their July Housing Availability Index from last year revealed, which I've included in the body of this email. Third is the foreclosure rate. A major cause of the housing crash last decade was the number of foreclosures that hit the market. They not only increased the supply of homes that were being sold, but they were sold at a 20 to 50% discount. Foreclosures helped drive down the market on all home values. Today, foreclosure numbers are lower than they were before the housing boom. Here are the number of consumer new foreclosures according to the Federal Reserve's most recent Housing Debt and Credit Report. 2003, 203,000, earliest reported numbers. 2009, 566,000 at the valley of the crash, and today 76,000. Foreclosures today are less than 40% of what they were in 2003. Fourth is housing affordability. Contrary to many headlines, home affordability is better now than it was prior to the last housing boom. In the same article referenced in home prices, CoreLogic revealed that in the vast majority of markets, the inflation-adjusted principal and interest mortgage payments that home buyers have committed to last year remain much lower than their pre-crisis peaks. They went on to explain the main reason the typical mortgage payment remains well below record levels in most of the country is that the average mortgage rate back in June of 2006, when the U.S. typical mortgage payment peaked, was about 6.7%, compared with an average mortgage rate of about 4.4% in March of 2018. The price of a home may be higher, but the cost is still below historic norms. The bottom line, for using these 4 key housing metrics to compare today to last decade, we can see that the current market is not anything like that bubble market. Thank you for taking the time to watch this video. Again, if you found the information to be informative, please subscribe, like, and share. If I can assist you or someone you know with any home loan needs, please let me know. I wish you all the best.